Welcome, everyone. Today we're doing a focused deep dive into the Bank of New York Mellon Corporation. That's ticker BK.
Right, the global financial services giant.
Exactly. And our mission today is, well, pretty straightforward. We want to analyze the current state of BK's stock. We're using a recent analysis report and insights from their latest earnings call.
And we'll try to keep it concise, aiming for under 15 minutes for you.
Let's jump right in then. Where does the stock stand according to the report?
Okay, so as of the report date, the stock was trading at $77.73 USD.
And it had a decent one-day pop.
Yeah, up $1.42, which is about 1.86%. The 52-week range is quite wide, $56.98 on the low end, up to $90.34 on the high.
Okay, market cap around $55.6 billion. But the enterprise value, that number stuck out to me.
Yes, a negative $882.32 million TTM. It's unusual, but not unheard of for certain financial firms.
What does that signal, really?
In simple terms, it often means their cash and cash equivalents exceed their market cap plus total debt. So basically a very strong cash position.
Interesting. Now, the report had a fair value estimate, slightly below the trading price.
That's right. $74.49 was the fair value estimate, and their specific price target was even a bit lower at $73.31. So yeah, it suggests the stock might be, slightly overvalued right now based on their model.
But how does that compare to what other analysts are saying? Is there a consensus?
Well, not exactly. The average analyst price target, looking back over the last 6 months, is actually quite a bit higher, around $89.
That's a significant difference. Why the gap, do you think?
It likely boils down to different assumptions, maybe about interest rate paths or how quickly their strategic initiatives will boost earnings, macroeconomic outlooks, things like that.
Makes sense. The report also mentioned a narrow economic moat. Can you unpack that?
Sure. It basically means their competitive advantage isn't super wide or defensible. They're pretty dependent on interest rate movements, which impacts their net interest income. Plus, broader economic conditions play a big role, and then there's regulation, like the SLR, the supplementary leverage ratio. Changes there can really affect capital requirements.
Right, and something about flat AUM versus AUCA growth.
Yeah, that was another point. Assets under custody or administration, the AUCA, grew nicely up 9% year over year, but assets under management, AUM, stayed flat at $2 trillion.
So they're holding on to assets they administer for others, but not growing the assets they actively manage themselves.
Pretty much. It kind of hints at that shift towards being more of a platform provider focusing on those custody and administration services.
Got it. So despite that flat AUM, how did their recent quarterly numbers look? Q1 2025.
Actually, quite strong. Revenue came in at $4.8 billion. That's up 6% year over year, or 5% if you exclude some notable items, beat expectations.
And the drivers?
Net interest income, or NII, was a big one, up 11%, mainly because they could reinvest maturing assets at these higher current yields.
Okay, that makes sense with rates having been higher.
Exactly. Fee revenue was also up, though more modestly at 3%. And earnings per share, diluted EPS was $1.58.
Wow, that's a big jump.
Yeah, 26% year over year, or 22% excluding notable items. Again, better than forecasts. Pre-tax margin hit 32%, and the return on tangible common equity was strong at 24%.
And that AUCA growth you mentioned.
It hit $53.1 trillion. That 9% year-over-year growth shows good client inflows, really underlining that platform strength compared to the flat AUM figure.
So you mentioned strategic initiatives like this platform model. Are those actually showing results?
It seems like they are, yeah. They said over half of their employees are now using this new platform operating model.
And that's leading to efficiencies.
Supposedly, yes. They cited improvements in things like trade finance, client onboarding, even payments. And their commercial coverage model, they apparently had their strongest sales quarter on record.
That's a tangible result. What about tech and innovation? We hear a lot about AI.
They're definitely leaning into it. They highlighted a multi-year agreement with OpenAI.
OpenAI? Okay.
And they mentioned having over 40 AI solutions already in production, with something like 80% of their employees having received AI training. So they're pushing it.
All right. Looking ahead then, what's their guidance for the full year 2025? Any changes?
No changes to the guidance they previously gave. They're still expecting NII to grow in the mid-single-digit percentage points year over year.
And fees.
Fee revenue, they expect some growth, but that's, quite market dependent. Expenses are guided to rise about 1% to 2%, excluding notable items.
Okay. Tax rate, capital return.
Effective tax rate expected between 22% and 23%. And they plan to return capital to shareholders roughly equivalent to 100% of their 2025 earnings, plus or minus.
So steady outlook. Now let's talk risks. What should investors keep an eye on?
Well, number one is probably interest rate sensitivity. If rates fall faster than expected, that NII growth could suffer.
Makes sense.
Regulatory risk is always there, especially potential changes related to that SLR calculation we talked about. The investment and wealth management segment is a bit of a weak spot right now. Its Q1 revenue was down 8% year over year, and pre-tax income actually fell 41%. That's significant.
Ouch. Anything else?
Just the usual broader concerns: macroeconomic uncertainty, geopolitical tensions, market volatility, and, as the report suggested, that slight overvaluation could be a near-term risk for new investors.
Okay, quite a few things to watch.
Mm.
But surely there are positives too. What are the key strengths?
Absolutely. You've got strong, diversified revenues coming from both net interest income and fees.
Right.
The operational efficiency gains and the success they're seeing from those strategic initiatives, like the record sales quarter, that's a definite plus.
And their financial position.
Very robust. High capital ratios: Tier 1 leverage was 6.2%, CET1 ratio was 11.5%.
Oh.
That provides a good cushion.
And the tech push.
Yeah, the innovation focus, like the OpenAI partnership, shows they're looking forward. And management seems pretty confident in their ability to handle whatever the economy throws at them. Resilience is key.
We saw some analysts adjusting their price targets recently. Any examples?
Yeah, a couple of notable ones. Betsy Grisek over at Morgan Stanley actually lowered her target slightly, down to $93 just recently.
Okay.
But then you had Glenn Shore at Evercore ISI raising his target to $79 around the same time. So still some movement and differing views out there.
Good to know. And for income investors, any dividend news?
Yep, standard stuff. They declared their regular quarterly common stock dividend of $0.47 per share. It's payable in May to shareholders of record, I think early May.
Okay, thanks. So let's try and summarize this. What's the main takeaway?
I'd say BNY Mellon is showing pretty solid recent performance. Execution on strategy looks good. NII growth is strong thanks to rates. But investors need to weigh that against the risks. Interest rate sensitivity is real. Regulation is always a factor. Market conditions are uncertain. And that wealth management segment needs watching. Plus, the valuation might be a little stretched right now, depending on which analysis you favor.
Right. It's a balancing act. So here's a final thought for you listening. How effectively can BNY Mellon really leverage its growing, strong platform business, the custody and administration side, to offset those potential headwinds from the economy, maybe lower rates eventually, and especially the current struggles within its own investment in wealth management division?
That's really the crucial question, isn't it? How much can the platform compensate?
Exactly. It could determine their long-term trajectory.
If you found this focused analysis valuable and you want more concise financial deep dives like this one,
Straight to the point.
then please do subscribe to our YouTube channel. And make sure you hit that bell icon so you don't miss future updates. Your support really helps us continue bringing you these breakdowns.
It does. Thanks for tuning in.
Thanks, everyone.